The Japanese yen has fallen into territory not seen since 1986. 100 yen is now worth only about 61 American cents. Japan is basically holding a 40-year clearance sale, but only if you're paid in dollars. And before you think this is somebody else's problem, the yen could affect your next vacation, your investments, the price of Japanese products, and possibly even your retirement account. But what is actually happening, and why can't Japan simply fix it? Let's follow the money. In 2021, $1 American bought approximately 110 yen. Recently, that same dollar has bought roughly 163 yen. So a tourist exchanging $1,000 would receive around 53,000 more yen than in 2021. Congratulations, your money just unlocked the Premium Japan Expansion Pack. A hotel room costing 30,000 yen represented about $273 at the 2021 exchange rate. At 163 yen per dollar, that same room converts to roughly $184. That difference could buy a lot of ramen, sushi, or one suspiciously expensive strawberry. But this discount has another side. If you earn your salary in yen, imported products and overseas expenses have become dramatically more expensive. Imagine a Japanese family needs to pay a $5,000 foreign tuition bill, medical expense, or overseas travel cost. At 110 yen per dollar, the bill costs 550,000 yen. At 163 yen per dollar, it costs 815,000 yen, an increase of 265,000 yen without the dollar price changing at all. Their salary didn't necessarily shrink, but what that salary can buy outside Japan absolutely did. So why is the yen this weak? The biggest surface level explanation is interest rates. Japan's key interest rate is around 1%, while the comparable American rate is roughly 3.5% to 3.75%. Imagine two savings accounts. One offers you 1%. The other offers more than 3.5%. Unless you're feeling extremely charitable toward the first bank, the choice looks obvious. Large investors can borrow relatively cheap yen, exchange it for dollars, and purchase higher-yielding American bonds or other investments. This is called the yen carry trade. Borrow cheap money here, invest it for a higher return over there, and keep the difference, assuming the currency does not suddenly move against you. Selling and borrowing yen adds more downward pressure to the currency. Japan has already tried fighting back. During 1 month in spring 2026, Japanese authorities spent 11.7 trillion yen, about $73.5 billion, buying yen in the currency market. Yet the yen eventually returned toward the same levels that caused officials to intervene. That money was exchanged from Japan's reserves, not simply burned, but the limited lasting effect shows how powerful global currency markets can be. Japan cannot raise rates aggressively without creating new problems for households, businesses, borrowers, and the government. Meanwhile, Japan must import most of the energy it consumes. Its energy self-sufficiency rate is only about 15%. Oil, gas, and other major commodities are commonly priced in dollars. That creates a painful chain reaction. Weaker yen makes fuel imports more expensive, raises electricity, manufacturing, and transportation costs. Those costs eventually reach supermarkets, restaurants, and household bills. In June 2026, Japan's yen-denominated import price index was nearly 30% higher than 1 year earlier, amplified by energy costs and the weak currency. Tourists see affordable ramen. Local residents see the ingredients, electricity, and delivery costs becoming more expensive. That contrast helps explain Japan's extraordinary tourism boom. Japan welcomed a record 42.68 million international visitors in 2025. Those travelers spent a record 9.5 trillion yen. For dollar earners, hotels, restaurants, luxury goods, and experiences can feel heavily discounted. Japan used to have a reputation as an expensive destination. Now some Americans look at the price of a domestic weekend trip and say, at this point, should we just go to Tokyo? The weak yen does not guarantee a cheap trip, however. Record tourism can mean expensive flights, crowded attractions, and hotel prices that rise fast enough to swallow part of the currency discount. Currency distortions have even appeared in gaming. Nintendo released a cheaper Japanese-language domestic-only Switch 2 that only accepts Nintendo accounts registered in Japan. In other words, international bargain hunters saw the price difference, and Nintendo effectively placed the console behind a velvet rope.
You shall not pass!
A weak yen can also benefit major Japanese exporters. Companies such as Toyota earn substantial revenue overseas. When foreign earnings are converted back into weak yen, the reported yen value can increase. But that does not mean every Japanese car or electronic device in America immediately becomes cheaper. Tariffs, local manufacturing, contracts, shipping costs, and company pricing decisions can absorb the currency advantage. The most important connection for investors may be the carry trade. In August 2024, the yen suddenly strengthened and investors rushed to unwind yen-funded positions. Japan's Nikkei suffered its worst day since 1987, and the selling spread through global markets. Nvidia dropped more than 6% during the broader rout. The carry trade was not the only cause, but it was one of the most widely discussed forces accelerating the sell-off. That creates the Great Yen Paradox. A continuously falling yen hurts Japanese purchasing power, but a sudden yen rebound can force global investors to sell stocks and other assets to repay their yen loans. Your portfolio can also be affected even without a dramatic market crash. Suppose a Japanese stock rises 10% in yen, but the yen loses 10% against the dollar. After converting the investment back into dollars, an American investor's gain is approximately erased. That matters if your retirement account owns international index funds, Japanese ETFs, or global companies with currency exposure. If you enjoy clear explanations of the stories moving markets, like this video and subscribe for more investing content. So, is the Japanese yen really collapsing? Japan is not experiencing hyperinflation, and the yen is not becoming worthless, but it has suffered a prolonged and historic loss of international purchasing power. The consequences are already visible in tourism, import prices, corporate profits, household budgets, and global investments. Foreign tourists experience Japan as a bargain. Japanese residents experience the outside world becoming more expensive. Investors profit from borrowing cheap yen, until a sudden reversal makes everyone race for the exit.
Boom, bam, bada boom, pow.
Japan can raise rates, intervene again, or tolerate further weakness, but every option creates a different bill, and eventually, somebody has to pay it. The question is no longer whether the yen matters outside Japan, it is how much of your money is already connected to it.